The law capping interest rates may be done away with a year after it came into force, as it continues to upset lenders' profitability owing to a dramatic decrease in their interest income. This was shared today at an event organized by Renaissance Capital by the Governor of the Central Bank, Patrick Njoroge, who based his argument for scrapping the law on preliminary findings of a joint study with the Treasury on the law's impact on growth of credit.
It is in our interest as a central bank to work to reverse these measures and let ourselves go back to a regime with freely determined interest rates, but in a disciplined environment. I can tell you the direction, but I cannot tell you when.
After the Banking Amendment Act of 2016 became operational, many banks resorted to redirect monies and instead invest in government securities, which eventually hurt the private sector. According to data by the central bank, credit to the private sector sank to 2.1% in May compared to over 17% in December 2015. Speaking at the same event, Barclays Bank of Kenya's Chief Executive Jeremy Awori said he hopes that the law will be reversed next year, the delay owing to the inconclusive electioneering period. He says the lenders will have to come up with a different model of pricing loans.
What I can say is the banking industry is mindful around not just, even if the law is revised or repealed, not going back to the days where it sort of got runaway interest rates. I don't think that's healthy for anybody. I think we really need to try and keep interest rates as low as they possibly can to make them more affordable and to extend credit.
Changing this law, however, would require going back to Parliament, and the central bank is warning commercial banks if the cap is lifted, they will have to be more disciplined in pricing loans so that they do not overcharge borrowers. On the country's economic forecast, Governor Njoroge was cautious of downgrading, saying the CBK will only review its 5.5% growth projection once second quarter data is in by the end of the month. This follows a number of economists lowering the outlook to below 5%, citing uncertainty over the election period. Hudheifa Aden, NTV.